and welcome to the first episode of Kent's Corner. Now, Kent's Corner is a podcast, a video blog. It's basically just boiled down data and information that you need to pay attention to that is going to affect the stock market. We're going to try to be as unbiased as we possibly can. The stock market's pretty agnostic to politics. I'm going to try to be agnostic to politics, but we have significant data that's coming through that really will affect the stock market, and I'm trying to bring that information to you so you can make wise decisions. We've got two sides of the coin here. We've got the bulls and the bears on which direction do they think that this market's going to go. We had a pretty terrible market last year. We've had a pretty great market this year, and what does that mean moving forward? And so this year, year to date, on the bull side, so the bull is investors that think the market is going to continue to go up. We've got the S&P 500 is up year to date 19%, the NASDAQ is up 36.4%, and the Dow is up 7.3%. Now, what does that mean? So last year in 2022, the NASDAQ was down around 33%, the S&P was down around 22%, and even bonds were down 18%. And so far, from the beginning of 2022 to this day, the NASDAQ is the only thing that is positive. And a lot of that is because of these AI stocks. There is a full frenzy on AI stocks right now, and that is driving the entire market. And so I don't know if you remember, a few years ago we had the S&P 500 and everything was the AA FANG. So that was Facebook, Amazon, Apple, Netflix, Google. And so now it is more driving on the AI stocks, and it's those top 10 stocks. Even looking at Palantir is up 210% this year. Now that is momentum. We'll get into what momentum means into the market a little bit later. But we've got some other good data that's come out. We might actually see a soft landing. Jerome Powell, I would do a golf clap for you right now because I think you're doing a pretty darn good job on what we could possibly do to make this soft landing happening. And so GDP continues to be positive. We have GDP rates. What are we looking at here? We're looking at 2% was in first quarter, 2.4% last quarter, and they're expecting that growth to continue to be up 3.5% for fourth quarter. We'll see if they make that. I think, we're seeing some of this cash flow that's still from the stimulus is still in the system, but other economists think that cash is going to flush through the system by the end of fourth quarter here. So we're looking at that soft landing. Inflation continues to come down. We're paying really close attention to that CPI data. That's Consumer Price Index. That's one of the major gauges of inflation. Next CPI data that comes out is August 10th. So we're going to be looking really closely. Look forward to our next episode on August 10th, where we talk about the new CPI data and what that means, because that's really going to be the roadmap and a driving factor on which direction Jerome Powell goes. We're also looking at the terminal rate from Jerome Powell. So Jerome Powell's terminal rate is around 5.38%, and that's about where we're at today. So with that information, we really are looking at that this last interest rate hike that we just had last week could be the last one we're going to experience, which would be incredible. Some economists think that they're going to hold tight on those higher interest rates until maybe end of first quarter next year, second quarter of next year, which would be wonderful to do that. The pain isn't over yet. A lot of that pig in the snake scenario that's coming through the economic data, those higher interest rates does create pain as that time goes on. And so we could see that through consumer spending. So far, we're not seeing it yet. We have discretionary spending is up. And so the consumers are driving our strong economy. So thank you, consumers. Thank you for spending money. Now, with the downside, with those consumers, they're getting used to spending a lot of money. So these consumers got a lot of stimulus money, they had a lot of extra cash, and so they bought a lot of extra things. And now car sales are up ginormously. That's even a huge part. I think it was over 2% of our GDP were Where in car sales, auto sales, well, those new auto sales, if you're financing those at all, you're going to have at a higher financing rate. If you purchased a new home, which home sales are still at a pretty good pace, they went down and the home prices started to come back up again. But those new home buys, that's going to be at a significantly higher interest rate, which could start shrinking discretionary spending by these consumers. The unfortunate part, the psychology part with that, is consumers have that lifestyle creep. Once you're used to spending money, once you're used to living beyond this structured budget, consumers don't like to pull back. And so when they do that, you start seeing credit increase, so consumer debt increase. And we're also starting to see consumer debt defaults. This is really important. I would say this is the closest thing to pay attention to on a bear potential is this consumer debt and debt defaults in general. We already broke one system. So Silicon Valley Bank, it's a really isolated incidents with these regional banks, but it did break. And so these regional banks did break that system, and there could be a spread with that, and that next spread potential would be those debt defaults, and a lot of that has to do with that lifestyle creep that's going up. Other negative things that bear economists are looking at is the overall economy. So even though our consumers are spending a lot of money, China's consumers are not. They are in a very painful situation. They are in a recession. Lots of Europe is in a recession. Japan is hurting with their high inflation, and some of Europe, as we know, that inflation has crept right back in. It had a resurgence, and that's a big risk to the United States. Would that risk come to the United States of a resurgence of inflation? And so if we see default rates come up and we see a resurgence of inflation, then watch out. Feds are going to have to make some extreme decisions on interest rates and tighten up that cash flow even more, which would be a bad time. That would cause the stagflation, because that would mean GDP is going down while inflation is still going up. That is a terrible scenario. We want to avoid that at all costs, and so far we are. So that's a really good thing. So what do you do with this information? What do we look at here? When you're looking at your investments, we've got really good options on interest-bearing accounts. So they call it the risk-free. Nothing is completely risk-free, but that risk-free rate in T-bills, you're up over 5%. You're around 5.3% right now. So the entire U.S. government would have to collapse for you to lose your money in a T-bill. But that is a really good scenario with the current interest rate environment that we're at. That also puts a higher benchmark on what your expectations should be when you're investing. That's put higher stress on high yield bonds. So these older corporate bonds are at a higher stress. So if they have any tightening cash flow, we're not really seeing any movements with that. I would revisit all of your high yield bonds, and you could be at a higher risk with a lower potential of return there. I would look at what is next as the stock market continues to grow. If it continues to grow, we are seeing some of the investments spread out beyond the tech sector, beyond that AI sector, that hype. Remember, when you win by momentum, that's also the opportunity to lose by momentum. You see the extreme examples in the meme stocks with that, and that's what we could experience there as well. But if this spreads out, if these investments start going into other sectors, that's just going to strengthen up that floor and that stability in the stock market. We could see that spread go into the financial sector. If we completely avoid a recession, then that business cycle would tell us that next step would be the financial sector. But if we end up having that R word head into the headlines again, then the financial sectors will not do well. But if we avoid that, that could be the next sector with some decent growth going into it. And so the end of this year is going to tell us a lot. We're going to see, where does GDP stand? Where does inflation stand? How are the Feds going to react and respond? Remember, the market's always baking the future into the now. It's really important to have a well-diversified portfolio, because if you go too heavy now, that puts you at a higher risk. And don't be a star chaser. So be very wary of looking at these companies that have had these extreme growths and trying to get in now, because these professional institutional investors like to eat these retail investors for lunch that jump in at the peaks and then they start taking those corporate profits. Historically, September is the worst performing month. There's a lot of things due to that. So when we do have a good year, then there's a lot of step backs in September. So I would not be a bit surprised if we see that pullback, that rebalance, people taking profits. That's when mutual funds start to rebalance their accounts as well. And so I would hold off. You might have that buy the dip, that buying opportunity in September. But don't, if you've got a long period of time for investing, don't keep cash on the sidelines for too long. So if you have some cash on sides, if you're looking for that investment opportunity, that dollar cost average is not a bad way to go on just dripping money into the market over a period of time to really capture that growth that's going through there. Thanks again for tuning in on Ken's Corner. We really appreciate you joining us on our very first episode. If you found this information at all valuable, please do us a favor. Like, subscribe, and share. Share this with your family. Share it with people that you work with that you think would find value in this boiled down information as well. Really appreciate you being here. And the next episode will be August 10th.